What if I told you the most powerful investing book ever written doesn't promise you quick riches, but quietly teaches you how to survive every crash the market can throw at you? Tonight, we're stepping into the world of Security Analysis by Benjamin Graham and David Dodd, the blueprint Warren Buffett calls his intellectual foundation. If you've ever felt lost in a sea of stock tips, market hype, and financial noise, this is the quiet, disciplined voice you've been waiting for. Think about the last time you felt FOMO in the market. A hot stock, a glowing headline, everyone on social media screaming, "Buy now." Graham and Dodd wrote Security Analysis in a world that had just paid the price for that exact emotion. The year was 1934. The Great Depression had shattered lives. Wall Street had gone from euphoria to absolute ruins. People weren't just down bad. They had lost everything: savings, homes, retirements, futures. Out of that wreckage, two professors from Columbia Business School decided to do something different. They didn't write a motivational book. They didn't write a get-rich-quick guide. They wrote a manual for how to look at a stock or a bond like a sober adult. Not as a lottery ticket, but as a real piece of a real business. Security Analysis is the book that says, "Stop guessing, start thinking like an owner." In this summary, we're going to walk through the core ideas of that manual, translated into simple, modern language. You'll hear about the difference between investing and speculation, why margin of safety is the heartbeat of every good decision, how to read numbers like a story about survival, and how to apply these concepts in a noisy, 24/7 social media-driven market without losing your mind. This is not financial advice. It's a tour through a mindset that just might save you from your next expensive mistake. So, let's begin. First, Graham and Dodd insist on a brutal question. Are you investing or are you speculating? Most people think they're investors. They open a brokerage app, buy a few stocks, maybe watch some YouTube videos, and call themselves long-term investors. But Graham and Dodd would push back. They say, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Anything else is speculation. Let's unpack that in plain English. Thorough analysis means you actually dig into what you're buying. You're not just buying because the chart looks pretty, or because a friend told you it's the next Amazon, or because some influencer said they're all in. Safety of principle means your first job is not to make money. Your first job is not to lose it. And satisfactory return doesn't mean get rich tomorrow. It means a fair return based on reality, not fantasy. By this definition, a lot of people who think they're investing are just dressed-up gamblers. Graham and Dodd aren't saying speculation is evil. They're saying, be honest with yourself. If you're speculating, call it what it is. But don't confuse it with disciplined professional investing. That honesty is your first layer of protection. The second big idea is the one Warren Buffett never stops talking about: margin of safety. Imagine you're building a bridge. The bridge is designed to carry vehicles that weigh up to 10 tons. Would you really build it so that it collapses at 10 tons exactly? Of course not. You build it to handle 20, 30, maybe 50 tons. That gap between the maximum load and the actual capacity, that's your margin of safety. Graham and Dodd say, do the same thing with your money. If you estimate that a company is worth $100 per share, you don't rush to buy it at 99. You demand a big discount. You wait until it trades at 70 or 60 or even less. Why? Because your estimates can be wrong. The world can change. A recession can hit. Management can screw up. New competitors can appear. The margin of safety isn't about being perfectly right. It's about staying alive when you're wrong. This is one of the most countercultural ideas in modern markets. Most people chase what's going up. Graham and Dodd train you to look for what's quietly, boringly cheap. Not cheap because it's trash, but cheap because the market is distracted, emotional, or just not paying attention. Margin of safety is not a trick. It's a mindset of humility. It says, I'm not smarter than the market every day, but I can demand a price that gives me room for error. To understand why this matters so much, Graham and Dodd start from the top of the capital structure, bonds and other senior securities. Before they talk about hot stocks, they talk about survival. When a company gets into trouble, who gets paid first? Bondholders. These are the people who lent money to the company. They don't share in the upside, but they stand ahead of common shareholders in a crisis. In security analysis, Graham and Dodd spend a big chunk of the book teaching you how to judge whether a bond is actually safe. They ask questions like, does the company earn enough year after year to cover interest comfortably? How stable are those earnings? What do the assets look like compared to the debt? Is this business cyclical and fragile or steady and resilient? They don't care about hype. They care about coverage ratios, stability, and protection. For example, they'll want to see a history of earnings that cover interest payments many times over. Not just one lucky year, but a record that survives bad years too. The message is simple. Before you chase returns, make sure the business can pay its bills in a storm. This mindset has a powerful implication. If you wouldn't lend money to the company, why would you want to own its stock? If its bonds are risky, its equity is even more exposed. Graham and Dodd flip our usual thinking. Instead of asking, how high can this go? They ask, how likely is it to survive? Survival first, return second. Next, they move down the capital structure to preferred stocks and hybrid securities. These are instruments that sit between bonds and common shares. They may have fixed dividends or special rights or convertibility into common stock. To many investors, these sound exotic and clever. To Graham and Dodd, they are dangerous when misunderstood. Their message: if you want the safety of a bond, own a real bond. If you want the upside of a common stock, own a real common stock. Don't let fancy structures confuse you. They analyze preferred stocks with the same harsh lens they use for bonds. Can the company really afford these payments through thick and thin? Are the protections clear? What happens if earnings drop? If the answer doesn't inspire confidence, they pass. They remind us that a security is not automatically safer just because it has the word preferred in the name. Safety comes from the business, not the label. In a modern world full of complex financial products, this lesson still hits home. If you can't explain in plain language how a security works, how it gets paid, and how it can fail, you probably shouldn't own it. Only after setting this foundation do Graham and Dodd turn to the most emotional part of the market: common stocks. This is where people dream. This is where fortunes are made and lost. Security analysis teaches you to approach common stocks with the same discipline you'd use for bonds, plus an extra layer of skepticism. Graham and Dodd talk about two big anchors for valuing a stock: earnings power and asset value. Earnings power is about the company's ability to generate profits in a reasonably normal environment, not in one miracle year, but across a cycle. They look at averages. They look at stability. They look at how profits behaved in bad times, not just good ones. Asset value is about what the company owns: its cash, its receivables, its inventory, its plants, property, equipment, minus what it owes. In some cases, you can find companies selling in the market for less than the value of their current assets, minus all liabilities. These are the famous net-net bargains that Graham became known for. Imagine buying $1 of cash, inventory, and receivables for 50 or 60 cents and getting the entire business, brand, and earning power for free. That's the kind of opportunity Graham and Dodd train you to recognize. Not because it sounds cool, but because it's mathematically lopsided in your favor. Again, they return to the core idea: margin of safety. If the assets alone justify your purchase price, any earning power is a bonus. Your downside is protected by the balance sheet. This doesn't happen every day, but when it does, it's often when the market is depressed, fearful, or bored. Exactly the times most people run away. But Graham and Dodd are not naive. They know that numbers can lie, or at least mislead. So a huge part of security analysis is about the quality of earnings. They ask uncomfortable questions. Are these profits coming from the core business or from one-time events? Are accounting choices flattering reality? Are expenses being pushed into the future? Is the company recognizing revenue too early? They warn against blindly trusting reported earnings per share. Instead, they recommend digging deeper. Look at multi-year trends. Compare reported profits to cash flows. Watch how management behaves. If a company shows smooth, ever-rising earnings in a world that is clearly volatile, that can be a red flag. Real businesses get hit by recessions, competition, and surprises. Overly perfect numbers may be massaged. Graham and Dodd want you to be a detective, not a cheerleader. The key takeaway: before you build an analysis on earnings, make sure those earnings are real, repeatable, and conservatively measured. Because if the foundation is shaky, the whole valuation collapses. Another powerful theme in security analysis is skepticism toward market prices. In today's world, you can see price quotes every second. Your phone buzzes, tickers scroll, charts flash red and green like a casino. Graham and Dodd treat market price as an opinion, not as truth. The market is there to serve you, not to instruct you. When a stock is trading at a price, that price is just the current consensus of a crowd that is often emotional, short-sighted, or misinformed. Your job is to estimate value. Intrinsic value, what the business is worth based on assets, earnings power, and conservative assumptions. Then, you compare price to value. If price is far below value and you can identify a margin of safety, you have a potential investment. If price is far above value, you have speculation or danger. The beauty of this approach is that it frees you from obsessing over every tick. You stop asking, is the stock up today? You start asking, is the stock cheap or expensive compared to what it's really worth? Sometimes the best thing an investor can do is nothing. Wait. Watch. Let the market come to you. In a world addicted to action, this is almost rebellious. Security analysis also shows respect for history. Graham and Dodd constantly look backward. They study how companies behaved over full cycles, how securities performed in past crises, how certain patterns of overvaluation ended badly. They know human nature doesn't change. Greed and fear repeat themselves. So they encourage you to see each company not as a snapshot, but as a story across time. Has this business proven it can survive recessions? How did management behave under pressure? Did they dilute shareholders, take on reckless debt, or play accounting games? Or did they stay conservative and honest? These questions matter more than whatever the stock did last week. In an age of memes and momentum, this is a radically patient perspective. Toward the later parts of the book, Graham and Dodd explore special situations, liquidations, reorganizations, mergers, and other events where prices can become dramatically misaligned with underlying value. They show that sometimes the best opportunities are not in the most glamorous companies, but in messy, overlooked corners of the market. A company might be winding down and returning cash to shareholders. Its stock might look dead to the average trader. But to a careful analyst, the numbers could show that the liquidation value is far above the current market price. These are situations where detailed, almost boring analysis can lead to extraordinary returns. What's the pattern here? Again, discipline over excitement, numbers over noise, facts over vibes. Now, how do you, as a modern investor or learner, apply all of this? Let's translate security analysis into a handful of practical habits you can use today. First, before you buy anything, write down why. Not because it's going up. Not because someone on TikTok bought it. Write down, in simple language, what is this business? How does it make money? How much does it earn on average over several years? How strong is its balance sheet? If the economy got ugly, could it survive? What do you think it's worth in a conservative scenario? And at today's price, what is your margin of safety? If you can't answer these, Graham and Dodd would say, you're not investing yet. You're speculating. Second, focus on downside first. Ask, how can this go wrong? What if profits shrink? What if interest rates rise? What if management disappoints? If even a mild negative scenario wipes you out, the margin of safety is not there. Third, be skeptical of too good to be true numbers. If a company's growth looks explosive, ask where it's coming from. Check cash flows, check debt, check whether earnings are driven by core operations or accounting tricks. You don't need to be a CPA, but you do need to be curious. Fourth, embrace boredom. Some of the best opportunities in the Graham and Dodd world are not sexy. They're not trending. They don't show up on the front page of financial news. They might be an old industrial company trading below asset value, a boring business with stable earnings and a low price, a bond that yields fairly and is backed by strong coverage. Boredom can be profitable. Fifth, accept that you will be wrong sometimes. Even with careful analysis, life happens. The point of margin of safety is not to guarantee success on every pick. It's to tilt the odds so that, over time, your winners and survivors dominate your losers. Graham and Dodd teach a game of probabilities, not perfection. Finally, let's talk about the mindset of the analyst. Security analysis is not just a list of formulas. It's a philosophy about how to think. The analyst is calm when others are panicked, skeptical when others are euphoric, humble about what cannot be known, relentless about understanding what can be known. You are not trying to predict the next headline. You're trying to judge the strength of a business. You are not chasing price. You are evaluating value. You are not looking for a story to brag about. You are trying to build a process you can trust. Graham and Dodd's world moves slower than ours. No smartphones, no zero commission trading, no meme stocks. But that slowness is part of the lesson. The core principles haven't changed. Distinguish investing from speculation. Demand a margin of safety. Respect the balance sheet. Question the earnings. Treat market prices as opinions, not commandments. And always remember, survival first, return second. If you carry those ideas into today's market, you're already playing a very different game from most people. As we wrap up this storyteller-style journey through security analysis, let's pause for a moment. If you're still here, it means something in this philosophy resonates with you. Maybe you've been burned by hype before. Maybe you're tired of feeling anxious every time the market dips. Maybe you're just ready to think like an owner, not a gambler. Benjamin Graham and David Dodd didn't promise excitement. They promised clarity. They promised a way of looking at numbers that protects you from your own impulses and from the crowd. You don't have to become a full-time analyst. You don't have to read every footnote in every report, but you can borrow their lens. The next time you look at a stock or bond, ask yourself, am I investing or speculating? Where is my margin of safety? Do the numbers tell a story of strength or a story of risk? And if the market closed for 5 years, would I still be comfortable owning this? If those questions feel new, go back, replay this summary, and let them sink in. And now, I want to hear from you. Which idea from security analysis hit you the hardest? Was it the brutal definition of investing, the insistence on margin of safety, the skepticism about earnings, or the call to treat price as just an opinion? Tell me in the comments what you're taking away. And if you're brave, share one mistake you made in the past that this philosophy might have helped you avoid. If this kind of deep-grounded approach to money and markets speaks to you, let me know by liking the video, subscribing, and sharing it with someone who needs less hype and more clarity in their financial life. Remember, in a world that worships speed, security analysis invites you to slow down, think deeply, and protect your future with discipline, not drama. Thanks for listening. Until next time, Invest thoughtfully, demand your margin of safety, and let reason, not emotion, guide your decisions.